Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. Chinese firms going big. This massive fundraising exercise as markets rally. Alibaba raising more than $3 billion in this year's biggest convertible bond sale, while NIO also hitting the markets, raising $1 billion in a share sale.
Now, stocks in Asia trading mostly higher ahead of U.S. inflation data after that soft PPI print lifted Wall Street and reinforcing bets on a Fed rate cut next week.
Plus, our exclusive with the UBS CEO Sergio Ermotti on the economic impact of tariffs, banking regulation, and China's deal-making boom. Good morning. Welcome to the show. As recently as about, I would call it 20 minutes back, we were looking at still some red. Now it's mostly green. So you have certainly the Nikkei and the Kospi extending the gains that we had yesterday. Keep in mind, global stocks are already on a 6-day run. We could get number 7 just judging by the momentum that we've seen in the last, let's call it hour and a half or so now. So you have the Kospi index up 0.3%. That market closed at a record yesterday. And of course, as we are continuing to push higher as far as that's concerned, that's now 8 days. Longest win streak in Korea, going back about 2.5 years. This is one market we're tracking as well. Going into the session today, TSMC, of course, and coming up, bottom of screens are shares as well. Certainly monthly sales indicative, again, consistent with this long, bullish AI theme, whether that's monthly exports numbers coming out of Taiwan, whether that's these numbers coming out of TSMC, boom, out of the gates, up 2.5% over in Taiwan. That now takes us to the macro picture. You have the 2s and 10s in Japan, 5-year bond auction yesterday. You have the 10-year yield coming up, and of course, this, I think it's 5 days now of a flattening in the curve. Well, 5 days going into today, we're slightly steeper on the 5s and 30s right now. Dollar is holding steady. We're looking at some possible breakouts, and we'll see what happens with the euro. We'll talk about that later on, but certainly inflation print coming through today is the key data point going into, I think it's 2.9%. Thank you so much for that reminder there. Okay. Overnight, we talked about Alibaba, likely to open slightly to the downside today. You have NIO, of course, and quite a big move there. And, of course, New Oriental Education is another stock that we're tracking going into the open today. 6% to the upside. All that being said, we're talking 9 days now of inflows coming into Hong Kong via the Stock Connect. Futures are pointing lower, materially lower, actually. We haven't really seen moves like this time of the day. And perhaps that's the Alibaba story. We can get to that later on. Dollar China, though, is still on the path lower, with both the offshore and the onshore rate now trading at the strongest level since about early November of last year. And take a look at that. We have now a 1.8% handle on the Chinese 10-year yield. Yvonne.
Yeah, it's certainly one to watch. Whether we do see a bit of a pause in this rally here, given the Alibaba news as well, or is this going to be just dip buying for a lot of the investors out there?
Point.
You take a look at what is on the agenda here today. So, of course, there's an MPC standing committee meeting as well. We talked about the southbound flow, so 9 straight days. We'll see if we see number 10 today. So we talked about Alibaba, NIO, China Pacific as well. You could add the 3 that basically have been raising money in this market as well. Offshore renminbi, of course, the strength that we've been talking about, and we're still waiting for that data coming out when it comes to credit and FDI as well. But certainly it's quite opportunistic that these companies are coming in, right? When we're talking about a bull run here, I think they're taking advantage of that to really kind of raise some money. Even, Alibaba has a massive cash pile as well, so you got to wonder why they're doing this too.
And what they're doing it for, right? A lot of that is going to data centers, and I think this deal actually reminded me to brush up on what they've done already so far. The last 12 months, I think they had a convertible. I think they also raised some money, and I think in a moment we'll be reminded of that as well. So I think they've had 2 cash calls already in the last 12 months or so. So I think I'll stand corrected, of course, if I'm getting that wrong. But in any case, of course, yes, this is just the latest iteration of these markets, underscoring the confidence that's back in these equity markets.
Yep, so certainly that might help or not. We'll see. But Alibaba, as we mentioned, like ADRs did fall some 2%. So NIO, collapsed about 7 or 8% in the U.S. session. So that brings a lot to the key sort of thing that investors are watching, which is the CPI print later on today out in the U.S. And I think the PPI run was pretty benign, so I think that helped kind of bring up all the Fed pricing and the like. But I think it's interesting, right? Whether we see a hot print in the CPI or core CPI this time around, does that lead the discussion to, can the Fed only kind of cut once this year? That's according to what Anna Wong and her team at BE is talking about.
Yeah, the market's pricing almost 3. 3 cuts in the remainder. Let's call it 2-3 meetings or so. So there is some room for disappointment, but how bad does that CPI need to be to then remove? I think the cut for September might largely be baked in already. It's the one after that that people are contending with as well. But again, the PPI print, if you remember this time last month, was what really kicked up this latest hawkish tilt coming through, because it was a very hot PPI number then. It was fairly benign, to your point, the one we got overnight.
Yeah, it's not going to be about tariffs, as they say. It may be more be about services, airfares, hotels, the like as well. But let's get to our top story here this morning. Alibaba seeking to raise $3.17 billion in an offering of zero-coupon convertible notes, and that's set to be the biggest transaction of its kind so far this year. Let's bring in our team, Asia Equities reporter Jeannie Yu. She's here with us in the studio, and also joining us from Taipei is our tech reporter Annabelle Jewelers. Jeannie, I'll start with you. What do we know at this point about this?
Yes, obviously, if you look at the ADRs, post in the extended trading, we did see some negative reaction. But when we talk to investors, yes, this is a very normal profit-taking or convertible arbitrage, where some investors, they would choose to buy the bond and then short the stock in the meantime. So yes, there will be negative reactions for the shares in the near term. But then in the longer term, when we talk to people, they feel like this is kind of like a positive for their business, because consider zero coupon bond is like they don't have any interest payments in the near term, and in the meantime, they got the cash to fund their AI expansion, their cloud infrastructure, which is the core business of Alibaba. So I think all in all, like some people even tell me they're gonna buy on dips, for any potential arbitrage related share correction. And then the other thing worth looking at is like the structure of the convertible bond is like they don't have the delta placement arrangements, so they only have like the cap call options, which means like there could be some potential dilution effect for Alibaba shares. But the terms is really strict, because it's only like 1% dilution effect if the shares rise more than 60%. In 7 years from now, so which means like that kind of dilution impact is a little bit far away. So I doubt that will create a lot of concerns in the market.
And it's only, I believe, an ADR deal as well. Belle, can I bring you in here at this point? So we know that they're raising the money. What are they using the money for? Is a key question there. And that's, I guess, where you come in, Belle.
Yeah, well, I think we know that it's going to be about 80% on their AI efforts, about 20% on the rest of the business. But I think it's really important. Jeannie just mentioned there that, they're sort of opportunistically taking advantage of that run-up in the share price. And, of course, it's very advantageous to the company. But also when it comes to their AI spending, well capitalized, but their AI spending is actually really expensive, and I think we saw that in the latest results. So just diving into the details, and this was also covered in a Bloomberg intelligence report that was led by Robert Lee a couple of weeks ago, but essentially investors like the AI story for the company, but as I said, it's spending a lot of money in these efforts as well. So in the 3 months period ending June, for instance, for the fiscal first quarter, we actually saw their free cash flow swinging to an outflow of $2.6 billion. CapEx during the period as well tripled to more than $5 billion. And then as well, you've got what actually the company is getting, what's their ROI, and that is still fairly small. Yes, it's rising, and again, investors really like that story of the gains we were seeing in terms of their AI revenue, but still on an adjusted EBITDA basis for that fiscal first quarter, it only came in at around just over $400 million, around $410 million. So the company is clearly focused right now on expanding its user base. It's not so much focused on expanding its gross margin, and so it does actually be needing, or does need rather, to raise more money.
And certainly we saw, I mean, they're throwing 1 billion renminbi of incentives in the whole AMAP boost as well. And it was quite interesting. I mean, we brought the story to viewers yesterday, but then we saw Meituan later on actually respond to that and also saying, they also have enhanced AI features in their app as well. Where are we now in this whole sort of rivalry between the two?
I mean, I think we're grisly. You know, it's very tough, and we know, of course, that there really no company is backing down. JD.com, Meituan, Alibaba, all of those are really still fighting over this food delivery, quick commerce war battle, or however you want to call it. But essentially, yeah, what we saw from Alibaba is that they're spending $140 million on incentives for users of the AMAP platform. So this is sort of a Google Maps sort of equivalent in China, but it has new features as well, and they're putting in this AI integration. It's going to have rankings for things like restaurants or local tourist attractions, businesses as well. And so for users that are doing things like taking car trips, ordering out or ordering in restaurants as well, they'll have those incentives in place. As you said, we had the clapback from Meituan. They also announced that they're going to be enhancing their own platform, Dianping, with AI as well, and also rolling out incentives. So I think it just really underscores, again, this battle is far from won right now.
It does seem, though, the initial opinion coming from markets, Bell, is in favor of Alibaba, simply looking at the share price, to your point, the run up there, and the opposite certainly on direction with Meituan. And I think just to also mention, Ellie Zhang and her team at Macquarie came out yesterday and cut their recommendation on Meituan to underperform with, I believe, what should be now, let me just verify that very briefly, is a street low at 75 Hong Kong dollars a pop. Jeannie, I'll bring you in this as well. So we've talked about the Alibaba part of the story. There are other companies coming to this market, which I guess underscores how hot this ECM market's been. There's NIO, of course, and there's also China Pacific.
Yes. I think especially for NIO is totally a different story. You see the ADRs plunging almost 9%. I think in general, people are really concerned recently about the ongoing price wars in the EV sector. You know, everyone is kind of rushing to cut prices for the new model, given that the government tries to put a cap on, on how much they can lower the prices for the existing models. And also for those new models, it's a little bit hard for them to control the margin and also to kind of have some differentiation in those models. So I think it is to me, it's a tougher landscape, facing all the automakers, especially, for smaller players like NIO.
Jeannie, fantastic. Thank you so much, team. That was Jeannie Yu there, our Asia equities reporter, and of course in Taipei for us is Bell, our tech correspondent on really the AI and tech overlay across all of these things, and maybe just to even mention that as well. So markets are shaking off this, what would have been this rather zombie-like approach to the open today, but this AI thing keeps coming and keeps really booming. Let me just mention this, right? TSMC out of the gates 2.5%. SK Hynix trading substantially to the upside. We're now hitting the highest level there on SK Hynix in 25 years. Another stock on your screens, Advantech. That's a record high for that specific semiconductor stock over in Japan.
And I think, what happened to Oracle again overnight, right?
Yes.
36% pop. I think you could say a jump, really, the most since 1992. And it wasn't just the outlook on the cloud business, which some say was quite aggressive, but they've really cemented their place in this race to support demand for AI computing, right? And at one point, Larry Ellison became the world's richest person for a few hours, just on that rally itself. So they've been talking about this deal with OpenAI as well to supply, 4.5 gigawatts worth of data center capacity, right? So that certainly does add to a lot of the momentum there as well. Coming up next, we'll be talking markets with Barclays and why they expect, 3 Fed rate cuts this year as well. Also getting their outlook when it comes to European equities in China and the like there. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Right, welcome back. So we're sandwiched between a PPI print, which was uneventful to the positive side, and let's hope that's the case. Otherwise, it's going to be a complicated conversation we'll be having tomorrow. Estimates on your screens, that's consensus. We're coming from a prior read to the right side of your screen. So you pick up in headline, and of course, you make your way down the list, and it gets into core, and of course, the sequential monthly indicators. Currently, I'm looking at my screens. We're looking at Fed Fund futures or swaps pricing in. So we have 3 more meetings, right? September 17, October 29. I'm talking in Asia day. It's December 10. FMOC for the year. We're looking at 2.8 cuts. Let's call it 3 cuts price
Call
there.
it 3.
Yeah.
Right now. Let's bring in Emmanuel Cau, head of European equity strategy at Barclays as well. Their house view is also for 3 cuts this year from the Fed. I mean, does this inflation data at all derail or potentially could derail this equity run that we're seeing across the world right now?
Yeah, I think you need a very, very high inflation surprise to derail this story. I mean, President Powell told us, look, we are going to look through inflation. We are mostly worried about the labor market. We want to prevent the slowdown in the U.S. economy. So we are going to cut anyway. And the view is, look, inflation is transitory, right? So I think you need a very, very high inflation data to really challenge this dovish pricing in the market, at least in the short term.
Equity markets have done exceptionally well this year. Do you see any reason to doubt whether this can continue or not? Is there any visible risk out there that might awaken this low vol environment we're in currently?
Look, I think the elephant in the room is the labor market, right? I think the equity market, the financial market are seeing the glass half full, i.e. they want Fed cut more than anything else, right? So I think this easing in the financial condition is what the market was waiting for a long time. I think the challenge to this Goldilocks narrative is if you see further weakness in the labor market. Ultimately, if you get another sharp repricing lower in interest rate, I think can only come with weaker labor market data. And that could challenge the view that, earnings will be resilient, consumer will be resilient. So I think the market now is repricing the, maybe a bit of peak Goldilocks narrative. And obviously the reality check could be you get further weakness in the labor market down the road that start to come with some concern about earnings and the consumer.
It seems like this AI trade has once again reinvigorated, animal spirits and the like. And this time it seems to be very focused on cloud. How should I position now around the whole AI theme?
I mean, firstly, this is something which, in our view, will keep U.S. ahead of the pack, right? To have a pro-U.S. allocation in our global allocation. Look, AI is a massive engine of this U.S. dominance. I also think it plays for the Chinese equity market, right? So the AI superpowers are U.S. and China. Coming from Europe, I'm a bit frustrated because Europe has missed this AI train, right? So I think that's something which will continue to benefit the U.S. equity market. Now, from a sectoral standpoint, we like tech broadly, but I guess, what market I think is looking at now is more AI adoption. Who will win from integrating, using, adopting AI? There's a lot of investment. There's a massive capex boom, as we know. At some point, the market will ask for the benefit of that. Who is winning from investing and using AI in the right way, right? So we like US, we like China, but I think beyond that, what we are looking for is what are the companies which are really benefit from this massive investment in AI and start to improve productivity and cut costs dramatically.
How does the China story, to your point, you're here talking to, how does the story of China resonate in Europe?
Look, I think you have different teams on China. I think the macro is still an issue, right? So if you look at European sectors, they do care a lot about Chinese macro. So luxury goods, commodities, materials have been really struggling this year because people are still not sure about the efficiency of stimulus and the potential for more stimulus in China. Now, I think along those, so there is this concern about China macro. But there is a lot of optimism on the liquidity support that we are seeing in China. We've seen the Chinese equity market really performing strongly. And I think there is this AI support as well, right? So it's a bit about AI and liquidity more than, stimulus, macro. Now, I think the new team, the new hot team in town is this anti-involution campaign. And whether this is really going to put an end to this kind of never-ending deflationary spiral. Massive market wants to see some evidence of that, but it looks like people are willing to give it the benefit of the doubt right now.
When it comes to AI in China, I mean, even just when it comes to some of the hot sectors like biotech, which have been on fire this year, it seems like investors are much more receptive of just the hope of these companies, that the hope is that all this mass investment and the like, despite the fact that they don't make any profits, is going to translate to something in the near horizon. That wasn't the case a few years ago, where people were really looking for earnings and looking for fundamentals. Do you think the psychology of this market has changed quite a bit and how investors look at it?
I think so. I mean, I think this is starting to change, right? So what we are seeing first is that the Chinese equity market is somewhat decorrelating the macro, right? So economy has been pretty stuck in a range for a while. Inflation is low, corporate profits are very low, and yet the equity market is booming. The best market in the last 12 months globally is the Chinese equity market, despite the economy basically disappointing, global investors. I think it's a bit more idiosyncratic now. People are looking for a secular growth theme at the sector level, whether it's AI, biotech, etc. So I think there's a bit of bottom-up, maybe approach to the Chinese equity market. While before it used to be pretty much a macro trade, right?
Yeah.
How much, at some point, people will start looking for earnings. So far, liquidity has been able to tide over that sort of time gap. Just from experience, looking at this market, low rates, a lot of momentum, a lot of hope.
Yeah.
These reinvigorated spirits, how long do you think these sort of periods of this Goldilocks period tend to last?
I mean, I think from a global standpoint, again, I think we are walking a very fine line. I think we can keep the party going as long as we don't see a meaningful hit to the labor market. It's all about the consumer in the US.
Okay.
As long as the consumer is holding up, I think the equity market will still look for the noise and the kind of short-term disruption in the data.
Right.
If you start to, as I said before, if you start to see a properly weak labor market, if you start to see negative payrolls and things like that, I think the market will start to question the efficacy of this Fed put and start to question the earnings story as well. So we are walking a fine line because we can easily go to the wrong side. And given the very low volatility, even though we are quite bullish, we think hedging the left tail is relevant and is sensible in this market.
Yeah.
I mean, European equities have done quite well, even better than the U.S. in some ways this year. A lot of his focus not really on the growth story, but really value. Does that continue? And what's the best way to look at the European equities?
Yeah, the banks have done very well.
Yeah.
Look, there is a bit of growth revival in Europe. I mean, that's mostly coming from Germany. Germany is going to spend 10% of GDP next 10 years to stimulate their economy. Yeah. So that's a big driver of the domestic, sectors in Europe. So we've seen the financials, as you said, the banks have been a very strong performer. European banks are up almost 50% this year. Yeah. Construction materials, domestic sector like consumer have done extremely well. I think what has been an issue for Europe most recently is a currency appreciation. Euro has gone up significantly against the US dollar, and a big chunk of European earnings are coming from abroad. And, the currency has been a drag. So I think what we need to see for Europe to be, performing further from here is some degree of stability in the currency. We need to see this export-driven sector starting to participate as well.
Emmanuel, nice to see you in town. Let's do this again next time you're back this part of the world. Emmanuel Cau there, Head of European Equity Strategy at Barclays. Going into the open today, under 6 minutes away. Futures and current pricing looking like this. We're looking obviously at Alibaba. More on that in a moment. This is the China Show. Good morning. All right, welcome back. You're watching the China Show. Just a quick preview of markets. Obviously, Alibaba and NIO with all the cash flows coming through. We're looking at some declines for both those names. The other thing that I suspect we'll spend a lot more time in the next few minutes or so is this sell down we're seeing substantially in the bio space, and we're down 7.5% in the early goings. The biggest drop in this cohort going back to April 7th of this year. More on this, plus the top stories in China. The opening bell is coming up next. This is Bloomberg. Good morning and welcome back. You're watching the China Show, counting down to the open of trade. And just when you thought this AI rally was exhibiting short-term signs of overheating, it seems like this rally has regenerative stem cells coming in, because it seems like we keep on going with this. Let me tell you, Advantech, SK Hynix, TSMC are all seeing substantial gains, and perhaps that's really what's carrying the load outside of Greater China. But apart from that, obviously, we're looking at other things, of course, in this mainland market. Yvonne, what's top of mind for you?
I think Oracle was certainly another day of a massive rally there that might be fueling some of these sort of chip stocks and the like here in the region. You have TSMC sales that were north of 30% or so in August. So certainly that did help once again invigorate that as a semi sort of trade here. But certainly we're focusing on maybe a potential pullback in the Chinese market here today, and that might be because of Alibaba. We'll talk about that in just a second. Onshore markets are doing this. We're slightly to the downside here today, and we're watching very closely, right? Because you're still seeing the likes of Cambricon. There you go. The chip space continues to be on fire here. We're up close to 2% in that A-share market as well. And we're watching very closely some of these yields. That 30-year yield is now down 1 basis point. So we'll see if we do see that rotation out of course, the stock into bonds once again, because certainly that could be the case when it comes to Alibaba, right? With the biggest convertible bond sale that we've seen this year, there is an arbitrage opportunity here, right, where you might actually buy the bond by shorting the stock. So that we might see that because the ADRs for Alibaba did fall some 2% or so. We saw that with NIO, which was basically the collapsing of the ADRs of 8% or so. Flip the boards to show Hong Kong here and see how some of these stocks are doing in Hong Kong. But yeah, certainly that could be a short-term sort of possibility, as Jeannie, you mentioned there. There you go. Alibaba is down 2%. Might that be a buying opportunity for some who are believing in this whole AI trade? But it's interesting, right? You talk about the amount of investment. BI, as Catherine Lim talked about this with this convertible bond. Is it a sign that Alibaba is really in a heavy investment cycle, and particularly when it comes to cloud infrastructure as well, and that the competition in China is so fierce that it is now starting to weigh on cash generation as well? Might that be a concern for the market, particularly when they're throwing 1 billion renminbi into subsidies when it comes to its maps and stuff, right? And that really is continue to show the fierce competition between Alibaba, Meituan, and JD as well when it comes to food delivery, right? So there you go. Meituan shares, though, we did see that pop of 2% after they kind of countered yesterday with their AI enhancements they say that they're going to have on the app as well. But it's really coming, this whole AMAP sort of thing is really becoming more of a navigation tool, but more so now becoming a leisure app, like a Yelp-like sort of app, like Dianping as well. You throw up the boards and see what other movers are watching very closely. So we talked about NIO. So yeah, this is a different story, right? Alibaba is certainly raising money to kind of continue to invest in AI. It's still in some ways a positive story, but NIO is really about talking about how they really are kind of faring not so well in this whole price war in EVs, and they are needing for cash as well. So NIO shares, we'll check those as well. There you go. We're down some 4% right now. Biotech, gonna watch this, right? This is one of the hottest sectors that we've seen in this rally. We are seeing a bit of a pullback here today. So the New York Times reporting that President Trump might be considering restrictions when it comes to some medicines from China, severe restrictions, as they say. We're not quite sure on details here right now, but the knee-jerk reaction is this right now, Dave.
Yeah. In fact, Morgan Stanley just commenting on that specific one, and I think while I read this out, just have a look at the biotech index itself. So we're down actually the most there since April 7th on that benchmark itself, well, that sector benchmark. And it's also worth pointing out, this has really been one of the best performing pockets of this equity market, so hence the temptation to scratch that itch and take that profit. I mentioned Morgan Stanley. They're commenting on this. We expect the proposed measures to potentially pose impediments, but they should not meaningfully impede the dynamics propelling the flow of innovation. Ooh, that's a long sentence with a lot of multi-syllable words. Fancy.
Basically saying
no issue here.
No issue here.
Yeah, there we go.
It's not going to stop the innovation going on. Yeah.
Let's. It's time for a look as well at some of the other top stories and some of the things making headlines across national media. So, state media is reporting on comments from Finance Minister Lan Fawon at the NPC Standing Committee. Now, Xinhua says Lan has pledged to improve its policy toolbox and maintain policy consistency, as well as sustaining efforts to stabilize these markets. Now, he also said the government will actively encourage the development of private investment. Okay, the financial papers, let's have a glance at that. What are we looking at here? Some are reporting on the strong performance of Chinese hedge funds this year amidst this market rally. Looking at industry data, Securities News says their average returns have hit nearly 25% year to date. Meanwhile, you have funds using quantitative strategies, ooh, fancy again, reporting returns here of 28%, outperforming discretionary funds.
Yeah, so certainly there's a lot of certain there's so much animal spirits, right? It's not just the equity market, right, that we've been talking about.
Yeah.
And we're getting to a pretty interesting sort of milestone here as well. If you bring up the chart, for the first time, the amount of money pouring in and out of China in search of investment opportunities is actually exceeding the value of goods and services its trade engines generate as well. So you talked about the hot stock rally, heavy trading of Chinese banks in terms of short-term debt have really contributed to the increase when it comes to these cross-border money movements, Dave.
Yeah, let's get the context here and what this perhaps means for efforts to internationalize the currency among other things. Tian Chen, who leads our Asia FX and rates coverage here, is here with us on sets to just help us understand. I think we'll start with a simple question here. How do all of these things actually aid China's efforts to challenge dollar dominance?
Yeah, that's a good question. So overall, the long story short, this development just means that China's efforts of opening the market have been bearing fruit, and that eventually will feed into its ultimate policy goal of internationalizing the yuan and challenging the dollar's dominance. And right now, it's also happening in an interesting window because now we are seeing this global trend of de-dollarization because people are growing concerned with Trump's policies as well as the dollar's haven status. So China actually has been stepping up the efforts of opening the markets since the start of this year. Of course, this is a multi-year process, but this year we're seeing an acceleration of this push. So overall, we're seeing China setting up the fast payment system with Hong Kong and potentially allowing more QD quota. So China is steadily moving towards the goal of letting the flows under the financial account to be more robust. So how does that feed into China's goal of internationalizing the yuan? So it creates a deeper and bigger pool of CNH offshore yuan liquidity pool in the offshore market. And that's going to allow more foreign investors to tap the CNH and to buy onshore assets. So all of that will fit into the ultimate goal. But the big caveat is that even though we are now seeing China's financial flows matching the current account trade flows, it's still falling far short behind what we're seeing in the U.S. and Japan. So in Japan, the financial flows versus current account flows, and for the U.S. can easily surpass 10 to 1, but for China it's now 1 to 1. So we're still pretty far away from the developed countries.
I mean, you mentioned about the surge in financial flows. It's still not anything compared to the U.S. and Japan, but how do you see these flows evolving moving forward?
Going forward, the market players that we talk to, they all say that it's going to continue to increase, and eventually it's going to take down surpass current account by a more and more significant amount. But they do say that it's going to be a very gradual process because we all know that when China does anything, it's going to be 2 steps forward and 1 step back because it really wants stability. It doesn't want crazy capital outflows in and out, and it doesn't want yuan instability. So it's going to do it very, very gradually to make sure that the quota system is in place. And China still, even after those reforms, they still have the capital controls in place. Is that they are dialing down a little bit. But when they see crazy outflows, they can easily turn the switch on and control the flows very easily. So it's going to be gradual. It's going to be a gradual process.
That's a good point. And, I mean, certainly we're seeing momentum, policy initiative. A lot of what you mentioned is also under China's control and their ability to control the pace of opening. What are the primary, whether that's external or internal, challenges or constraints that then sort of might impede the process?
I think the biggest challenge, I wouldn't call it a challenge, but a dilemma, is because the PBOC almost wants 2 things that are contradictory. It wants liberalization of the markets, but at the same time, it wants control of the markets at the same time.
Impossible.
So it kind of wants, the impossible trinity theory. So I think I would say the challenge or the dilemma there is that you always have to pace it very carefully. So that can slow down the whole process. That's why we're talking about 2 steps forward and 1 step down. Sometimes people would say, is China pausing the opening up push, or is it China even reversing the push? So there are going to be doubts along the way. But overall, I don't think China is going to backpedal the whole reform, but it's just going to be very slow.
Fantastic. Tian Chen there who...
We've missed you, Tian Chen.
Yeah, I know. 好久不见, right? So let's do this more often. And you can catch, of course, her team's work and this fantastic piece. It's on the Bloomberg terminal today for our Bloomberg clients. It's also on the internet in case you have a connection. All right, let's talk about UBS. So we spoke to the CEO earlier. He joined us here on set about 2 hours back here. So he's in town for this big tech conference. So we talked about many things, one of which was Switzerland's overhaul of these requirements for the bank to set aside more capital. It certainly handicaps, he says, the competitive advantage of local banks, not just UBS. So we did speak with Sergio Ermotti earlier, and he says that banking regulation debate is a huge distraction.
We do accept that there is a necessity to fine-tune many aspects of regulation in Switzerland, but on capital, I think the requirements that are proposed are excessive, and they are not really targeted to address what happened at Credit Suisse. So we are engaged in the public debates, and in the next few quarters, we will see some outcome of the political process.
Shrinking the bank is not something that you prefer. Yeah. You know, that the franchise is Swiss-based and your global franchise gives you that competitive advantage. The reason I frame it that way is I wonder, and risking oversimplifying a complex issue here, does the regulation in some way handicap the Swiss competitiveness when it comes to banking? Well,
of course, when you have a proposal that would see our bank having to hold, 50% more capital than your competitors, then of course you would have an impact on that. But it's difficult for me to see a successful global organization that is very close to clients, that is very resilient and strong in terms of capital, embracing a strategy of shrinking as a good way to succeed in the future. So we are very focused to keep our global footprint.
The message you would give to investors, clients, employees that, hear this almost on a regular basis, concerns around the bank shrinking and whether or not that's fully under your control. What is the message that you're able to give at this point in time?
Well, I think that we and the board of directors and the executive board are very determined to continue to execute our successful strategy, and shrinking is not an option.
How about the headquarters, that conversation there?
No, but we want to continue to operate as a successful global bank based out of Switzerland.
The management committee and yourself wouldn't be doing the job if you weren't planning for Plan Bs or Plan Cs. And not to speculate, of course, but what are some of the worst case scenarios that have been gamed out in the event you need to start entertaining some of these options?
Well, the worst case scenario is quite clear. It's already on the table. So I think that one is a scenario that we will need to evaluate and understand, but is definitely too early to jump on commenting any potential scenario and what our responses will be. Of course, the requirements as they are very punitive and excessive, and therefore we would need to think about how to protect our shareholders and our stakeholders' interest.
Understood. And I think just to clarify that point, because in my head there are two things here. It's either you set aside more capital or the headquarter question. I know that's oversimplifying the equation here, but do I take it then that you would rather put up more capital than move the bank out of Switzerland?
No, I mean, look, our preferred option is to have a reasonable outcome of this regulatory changes that is addressing the true lessons learned from what happened at Credit Suisse, and not simplistic options. And we want to continue to operate out of Switzerland based on that kind of regime.
What's your sense of the global economy, and where do you think we will be in 6 months' time? Are we going to be better off or worse off?
Well, look, the issue is that I don't think we have seen really the true impact of tariffs playing out in the economies. Of course, when you look at Asia and China in particular, it's fairly robust. 5%, comfortably about 5% GDP is quite a strong momentum.
Two good-looking gentlemen there, of course, the UBS CEO and yours truly. Clearly, only one person is convinced on your screen. All right, coming up on shows here. In fact, Mr. Ermotti's in town, of course, for the UBS Tech Conference, Disruptive Tech Conference. We'll be live, of course, out of there with the founder and CEO of how they're actually shaping the pipeline and competing in Asia's fastest biotech markets. Piers Ingram joins us, of course, to talk us through what they're doing with their business. Plenty more ahead. This is Bloomberg.
The UBS Disruptive Tech CEO Summit is underway here in the city and bringing together industry pioneers and leaders to discuss innovations and advancements. Now, our next guest is the co-founder and CEO of biotech firm Hummingbird Bioscience, known for developing antibodies for cancer. Piers Ingram joins us now. Piers, it's great to have you. And yeah, we'll try to cut through some of the noise there, but I want to get your take. I mean, you're a Singaporean-based biotech company, but there has been a lot of headlines that we just talked about with President Trump considering some severe restrictions on Chinese drugs, for example. How does a headline like that, how do you react to something like that? And does it actually change or impact the innovation that's going on in the industry now?
I think biotech innovation has always been incredibly global. Science, as we know, is a global pursuit, and drug development, particularly in something as important as cancer, I think is very much not restricted to one geography or another. That said, I think we all know the importance of the US market, and I think some of the considerations that the US policy environment has proposed, I think the kind of understandable considerations about how to ensure that there's kind of equity and fair development of the industry. But I think for the most part, for the area of the industry that we're involved in, which is a relatively early stage from fundamental discovery through to the proof of concept, it's less impacted by these types of changes.
So Piers, thank you so much for giving us the sort of big picture take there on perhaps changing regulation. I want to focus in now on what your company does, and we'll get to the fundraising in a moment. That's a cue for the next maybe question later on. But tell us, what are you busy with this year?
Yeah, so the company started a decade ago really with a vision of applying this next generation of technologies to drug discovery, trying to make drug discovery and development much more of an engineering and optimization problem than I think the kind of low success science-based endeavor that it's been over a long time. And the acceleration of technology in the last 3-4 years has really helped us out. We have a number of drugs in the clinic at the moment in mid-stage clinical trials that we're very excited. We hope to potentially enter registrational studies as soon as next year for the lead program. And we have a number of other drugs coming up behind that. So yeah, we're very focused on the development of our internal pipeline.
Piers, we've talked about China biotech. I mean, this is a sector that is, some say, has having a deep seat movement here right now in terms of the amount of innovation, and it's rapidly sort of grown. How does Hummingbird deal with that sort of competition? I mean, they are seeing a lot of progress in the antibody space, which you operate in as well. How does Hummingbird stand out, and would you consider partnering with any Chinese companies?
I think, like all overnight success, it's taken a decade, and I think Hummingbird and many of our colleagues have been working in this ecosystem over this last decade, and have been delighted to see the development of this industry here in the region. So I think it's not a sudden change as far as we're concerned, and it's great to see the fruits of all of the work that people have done being recognized and starting to have a real impact for patients. Again, for our view is that biotech is an incredibly global endeavor. There are real strengths that the ecosystem in China has had, particularly in some of the manufacturing and early research activities, and increasingly in clinical development. But clinical trials, particularly as we get to the later stages of them, generally require patients from different regions to participate in them, so we know how these drugs work in different populations. And I think we are also also looking at running our trials here in China as well.
Okay, understood. Piers, can I just ask you about the financing part of the business and perhaps when that comes in and how that affects your plans moving forward, or your capacity to, I believe you're also looking to expand your pipeline of drugs as well. Correct me if I'm wrong, the last time I believe that you raised financing was 4 years ago in 2021. Are you planning any fundraising, and is an IPO perhaps in your near future?
I think it's certainly something that we're actively considering. The market in 2020, 2021, as we know, it was a good time, and there was a lot of optimism about the biotech industry. And the last 3-4 years have been very challenging for the whole industry, and we've seen a lot of good companies, a lot of good science, unfortunately, have to take a back seat to the realities of the financial environment. It's great now to see renewed interest in this industry from investors, and I think, again, coupled with the advances in technology, some of the new modalities, there's, I think, good reason for that excitement. And so, yes, I think for us, given the stage of some of the programs that we're working on, thinking about how to ensure that the company is well capitalized and potentially including a public market strategy.
Piers, thank you so much for joining us. I know that there's a bit of noise in the background, so thank you also for being a good sport, and hopefully things came quite clear. Co-founder and CEO of that Hummingbird Bioscience. In the next hour, of course, we'll be hearing, and also live then, hopefully not as noisy, with the founder and CEO of VC firm 3C AGI Partners on the investment opportunities they're seeing in AI. Esther Wong joins us at those times on your screens.
All right, we've been talking about biotech. Let's continue that theme here today. Quite a bit of a sell-off here when it comes to these China drug companies here as well. There's a report from the New York Times that the Trump administration has been discussing severe restrictions on medicines from the China market there. So certainly that's one to watch. What does it mean? Does it mean some executive orders? Everything's kind of lightly been talked about here as well. But Morgan Stanley say, look, it might not actually lead to any sort of impact on innovation, but for now, it could actually have some impediments in the near term. You're watching The China Show. Welcome back to The China Show. Here's a look at the CSI 300 just a half hour into the session here. And yeah, we're still seeing some green, though, modestly higher. But you take a look at offshore in Hong Kong, we're down some 1% here on MSCI China and the Hang Seng here this morning. And I think you got to blame one company, Alibaba, here today, Dave.
Yeah, down about 2%. That's the drag. We have that stock to thank anyway as well. The fact that we're trading at about 26,000 is also because of Alibaba. But yes, the ebbs and flows of markets are hence the same as the ebbs and flow of life.
Ah, so poetic.
There we go. I don't want to get in my head. In fact, on Alibaba itself, have a look at where we are there. So we actually opened, I think we're slightly coming off lows, if I'm not mistaken here. We did touch, of course, at one point yesterday, the 146 mark on the price itself, and then of course you had that massive deal that was announced post-U.S. market close. A little bit of reaction in the post-markets, this extension going into the session today. And speaking of cash flows, right, NEO was one, China Pacific, in case you missed that, insurance was another one as well, and maybe taking the brunt of the opposite side of the Alibaba story and the competition conversation is Meituan, and right? And I think Macquarie came out yesterday and slashed their outlook on the stock, underperformed, and currently has the lowest price target there for Meituan at 75.
Yeah, when you have Alibaba throwing hundreds of millions of dollars into really adding AI-enhanced sort of features.
They responded, though.
Yes, and they responded saying, we're going to do the same. Yeah. So it just goes to show, right, this rivalry is not really ending anytime soon when it comes to the food delivery space as well. And I think, these navigation tools are now turning more into like leisure-like type apps and stuff is really kind of be an ongoing theme. And maybe, a reason why Alibaba is going to be continuing to face a lot of pressure. And maybe that's why they are raising all this cash right now as well. So certainly that's one thing to watch. But it was a very interesting sort of quote that we got a report from Morgan Stanley that just came through in our inbox here from Laura Wang and her team. They just came back from a marketing trip in the U.S. And the amount of interest from U.S.-based investors, they say, is quite remarkable.
Yeah, it's the highest level. So the percentage of investors that they've spoken with, over 90% think that they have expressed their explicit willingness to increase their skin in the Chinese market, the highest level, to your point, going back to early 2021, which is interesting, that timing early 2021, because that year keeps coming back a lot this week in terms of superlatives, because a lot of the prices are actually back to those levels. And, you know, if you, I guess, took a random sample of what is one Chinese stock and you asked a pool of U.S. investors, my guess is they would say Alibaba. Like, that's the first thing that would come to their mind.
Well, they said it goes beyond just buying an ADR, right, or buying a tech share, they say, right? That there actually is a little bit more interest in the A-share market as well because of all the themes that have emerged. And they said you really have to do your individual's homework on each individual stock because there's so many themes like humanoid robots now on a company-to-company level, which is quite interesting as well. Anyways, they still talk about some concerns in this market as well. We'll talk a little bit more about that. Let's bring in Winnie Xu, our Asia equities reporter, who's tracking all things for us here today. Let's first talk about what's leading this sort of pullback in Hong Kong. Is it all Alibaba or what else?
Exactly. So I do think that Alibaba is a key driver because just how it has led the rally so far in the past few sessions in Hong Kong. But when you look at this big convertible bond issuance here, overall, I think it really goes to show how these companies are taking advantage of this hot market right now. Lots of interest, as you mentioned, from Morgan Stanley as well. So it really depends on how investors are taking this in terms of the purpose of this issuance, right? On one hand, you have Alibaba putting more money into AI. That's that hot theme there. So longer term, it can be good. But on the other hand, when it comes to NEO, then there's a bit more price pressure around those fronts. So a bit more concerns around kind of the financial health over there. So shorter term overall, it does cause a little bit of a volatility in the market just because investors are looking to reposition, and especially after quite a big rally and rotating potentially away from these overheated sectors into some of the laggards that we're seeing in the overall index. So that's kind of like a healthy little correction here. But going forward, we really need to see like where this money is going to be positioned in.
What seems to be consistent largely is just the interest in AI and chips. So what are you guys seeing today there?
Yeah, lots of interest, right? Because when you kind of strip away the little correction that we're seeing here in the Chinese market and look at the broader Asia market, actually tech is still leading gains. When you look at TSMC, just came out with the August monthly sales data that actually was very positive and pushed the stocks up about 2% or so today, I believe, and also still very strong. The shares in Japan as well. Oracle Japan extending gains even after the news that came out around Oracle's outlook as well. So overall, that big theme around how the AI demand is still solid, and that really is translating into gains in the relevant supply chains across Asia as well. So continuously, that is going to be the highlight of the recent trend we're seeing here.
Winnie, thank you. Winnie Xu there, our Asia equities reporter. And more now, of course, on this $3 billion fundraising plan from Alibaba, which is said, of course, to be this year's biggest when it comes to convertible bond issuance, right? Joining us from Taipei, let's bring in Belle, our tech reporter, on the details of this, the rationale behind it, Belle. But I think it just goes to show, you know, Alibaba is really digging their heels in this whole investment cycle when it comes to AI now.
Yeah, that's right. I mean, it's a really costly endeavour for the business. So I think on the one hand, and then Winnie was just pointing it out there, it sort of makes sense in terms of the run-up that we've seen in this stock, and they're sort of looking to take advantage of that because this is zero coupon, of course, so investors aren't going to be getting any bond payments for it. So that's sort of one of the reasons this is being looked upon perhaps favourably. Short term, you know, we're hearing that you can expect more volatility ahead, essentially, because there's arbitrage opportunities that open up. So you might look to buy that bond, short the stock, though, in the meantime. But generally, you said, you know, it's this sort of idea around AI and how the company is going to be looking to spend this nearly $3.2 billion. 80% is going to be going into AI, 20% into the rest of the business, but it's a very, very costly endeavour. And you really saw that in the latest reporting period, for instance, because you saw their free cash outflow turning to a negative for the business, so down $2.6 or $2.4 billion. Then you've also got how much capex, so how much are they spending in terms of AI, and you saw that tripling in the latest period to more than $5 billion. Then you've got their their ROI, and that's still, yes, starting to increase, and investors really like that story for the business. But even on an adjusted EBITDA basis for that period ending June, they were still only making just over around $410 million from their AI efforts. So there's really big discrepancies here. You've got to spend to win the race. Try and increase the user base. That's the big focus of the company, on user base, not so much on gross margins. But at the same time, it does cost a lot of money to do that.
Yeah, and it's coming at a time when investors perhaps are not as patient in terms of waiting for, tangible financial results, right? And I think, the food delivery scene, Belle, just to bring that in, and I wonder what your thoughts are on that, is really one place where competition is heating up, and it's not clear who emerges the win here at the end of this tunnel.
Yeah, well, I think, and you were making that point earlier, that we've sort of seen Meituan, for instance, getting these downgrades. They have, of course, had the worst numbers in the latest reporting period, but really as well doubling down. I mean, it's sort of been their bread and butter business. It's a huge race. I mean, it's between Meituan, Alibaba, JD. They're all spending aggressively. They've all got aggressive plans as well. And you saw that, as Yvonne was mentioning, the investments, for instance, that Alibaba's looking to make into AMaps. That's sort of the Google Maps equivalent in China, but has more features. And you've seen these enhancements through AI that you're going to have sort of rankings now that for businesses, tourist attractions, restaurants, and more. So they're essentially offering more incentives to users to try and drive them to the platform. Meituan's pushed back on this. They've also said they're going to enhance with their own AI features, roll out more incentives as well. So it sort of continues to be this race to the bottom, even as you've got government policies, for instance, really talking about this need to cull anti-involution. It doesn't seem like companies, and food delivery is one of the hardest ones to curb, are really heeding any of those calls for now.
Yeah, it doesn't look like that's evident at this point. Belle, thank you so much. Annabelle there, of course, our tech correspondent in Taipei for us. Just ahead here on shows, we'll be speaking with VC firm and really furthering the AI conversation here. 3C AGI Partners on specific opportunities they're seeking when it comes to AI there. Plus, China-Britain Business Council will be joining us, as well as Beijing and London actually gear up for high-level trade discussions. All those are coming up here on The China Show.
DeepSeek and Alibaba's Qwen have both gained a lot of traction globally. These are the top two performing open source engines in the world, and there are others from China. The American open source is well behind. So while the whole world may or may not want to use Chinese software, the fact is that open source, the models are available for you to take without charge to do whatever you want. And you can remove anything you don't want, add anything you need, and that flexibility, openness, actually gains trust.
Yeah, that was Kai-Fu Lee there out of Sinovation Ventures, of course, the chairman and CEO of ONAI, of course, speaking with us earlier, really, at the UBS conference. In fact, let's head back there to the UBS Disruptive Tech CEO Summit taking place here in the city, and discuss the investment opportunities in AI with Esther Wong, founder and CEO of 3C AGI Partners, an AI-focused VC firm. Esther, good morning, and thank you for taking the time to speak with us today. And it's quite timely, actually, because the market is falling in love with this AI theme over and over again. And I really wonder whether you think the market is overestimating AI or underappreciating AI. What's your sense of what's going on overall? Then we can talk about other things.
Sure. Good morning, guys. Thanks for having me. So yes, there is a lot of AI play happening right now, and there are many layers of AI. So we have AI infrastructure, AI applications, and also a lot of AI data that goes into AI. So I think when it comes to the overhype, a lot of it is on the actual use of AI versus the hype of the promise of AI. So AI promises a lot of things, but when it comes to actual implementation, sometimes people are running into trouble. So I think there are opportunities in terms of implementation of AI itself.
Okay, tell us a little bit more about what's the investment landscape looking like. I mean, I know there's a lot of money being plowed when it comes to AI investments as well. How are you seeing the amount of interest, whether it's in the U.S. or China right now?
Yes, you're absolutely right. There's a lot of money going to AI investment, and I do believe that a lot of money right now is focusing on two aspects. One is AI infrastructure, i.e. things that we cannot see, but is fundamental in terms of laying the foundation for the AI that will be in place and we'll be using. Now, the other big part is on AI application. So as an investor ourselves, we focus a lot on AI infrastructure. And the reason being, I believe that we are in a turning point in the history of usage of AI, where more AI compute, starting from 2025 this year, is pivoting from training of AI to actual inferencing of AI. So inferencing of AI is when people actually utilize AI for various things such as your ChatGPT, such as Perplexity. And we believe that we're in the AI 2.0 era. So think about AI 1.0 as when AI is trying to figure itself out. And AI 2.0 is when AI is starting to get really popular, like all of us will have an AI device with us. And AI 3.0, however, is when AI is going to be the primary use of AI itself, so that AI could be genuinely, we enter into AGI era, so to speak. So as an investor, we believe that there's a lot of opportunity in terms of fine-tuning the infrastructure that is needed in the so-called AI 3.0 era, where AI is the actual use of AI itself.
Yeah.
Yeah, and Esther, talk to us, if you could be more specific, hopefully, so a lot of people talk about infrastructure. And as someone who's actually investing in the weeds here in specifics, people talk about energy, people talk about hyperscalers, for example. Beyond those two things, are there actually other things that we should be focused on as it pertains to this whole infrastructure theme in AI?
Sure. So the reason that AI infrastructure is so interesting, as you probably know, David, is because AI accounts for a lot of power, right? AI accounts for 4% of the global power in 2024. So at this rate that AI is pivoting, the world could potentially run out of power. And that's why guys like Sam Altman say that whoever controls power controls AI. Now, however, when we go back to first principle, why is AI taking up so much power? So there are a few reasons for that. And first and foremost, the current way that we're building AI is not the most efficient way of building AI. So that comes into three buckets of major solutions. Number one, all the AI that we're using right now is based on this so-called transformer architecture. So are there ways to make transformer itself lighter and faster? So on the software side, there are ways to make AI algorithm itself lighter. So that's one bucket. The second bucket is a lot of times AI is running on NVIDIA GPU, and that's why NVIDIA share price went up 30 times in the last 5 years. But as I mentioned before, we're entering into from training era to inferencing era. So do we have other alternative hardwares that can also run inferencing that is more suitable for the AI inferencing era? So the second bucket is hardware, alternative hardware. And the third bucket is, as you mentioned very correctly, what about alternative energy or renewable energy? So nuclear is a very big part. So those are the three buckets that as an infrastructure investor, we can look into and dive into, and tons of opportunity there.
Esther, I want to talk about some of the companies that you're focused on. StarCloud CEO, this is part of the infrastructure, building data centers in space.
What?
Can you tell us a bit more about why space?
Okay, so yes, that goes to the second bucket when I think about alternative infrastructure. Because as we know, building data center is very, very costly. Stargate project is $500 billion. And why is that? Because it takes money to buy the land. It costs money to build the building. And once the building is running, 50% of the power actually goes to cooling itself. So think about it, right? Space offers a really good alternative because, first of all, you don't pay for the land, you don't pay for the building, and guess what? Space is minus 250 degrees. So cooling is very, very easy as a result. And the best part is solar energy is essentially free in space. So it relieves a lot of the cost pressure of data center on Earth. On top of that, of course, there's also strategic reason why we need to have a spare alternatives on data center on terrestrial planet as well. So I do believe that when it comes to actual running costs, by the way, space is 70%, 70% 50% lower than running a data center on Earth. So we believe that this is the ultimate sustainable solution.
Yeah, but we need to get there, though. I guess my question, how is this? Are there companies right now that have tangible, realistic plans for all these things to be actionable, Esther?
Absolutely. Now, this is a very good question because, of course, as AI practitioner ourselves, we thought about having edge inferencing with the satellite for many, many years. But for the longest time, it's not even possible, remotely possible, because the launch cost itself is very, very high. So then with the emergence of guys like Starlink, SpaceX, it actually reduced the launch cost significantly so that the cost of trial and error is a lot cheaper. And so we hear about space tech for the longest time. However, I do believe that with the commercialization of SpaceX, you can think about SpaceX like the Uber of space. Then a lot of the space technology can become fruition, can turn to reality. And I do believe that we are at the pivoting point of that. So this is very exciting to witness, and we are the first. And as a matter of fact, we will have our first launch before the end of this year. So we are very much looking forward to it. So we're part of SpaceX on this project.
Yeah, keep us updated, and I want to hitch a ride to space as well. Sometimes
Yes,
the troubles at Earth here, back on land, really give me reason to look up and hope.
Yeah.
Esther, thank you so much. Esther Wong, the founder and CEO of 3C AGI. Really, that's a good example of when your head in the clouds is really not a bad thing if you think about it. You look beyond and see the infinity. Efficiencies. There we go. Big word. All right, plenty more ahead. This is the China Show.
Well, Taiwanese tech giant Advantech is planning to scale up their U.S. production to minimize the impact of President Trump's tariffs. Speaking with us exclusively from the sidelines of Semicon Taiwan, the president of Intelligence Systems Sector, Tsai, also gave us her outlook for the AI industry.
If you look at the semicon in the recent year, I think the biggest growth driver is from AI. It drives the semicon growth, especially on the semicon on the advanced manufacturing and also on the advanced packaging. So if I look at AI driving the semicon growth, because more GPU, NPU, and connectivity, and even the HBM is required. So we see semicon growth, which means more fab and more semicon equipment is needed, and that's drive the Advantech business to grow. In terms of like AI implementation, I see in two different ways. Right now, AI is heavily used on the high-scale training in data center. That's like buying a lot of the NVIDIA server. But again, since 2022, generative AI, and we talk about fiscal year early this year, I see AI at the edge is just around the corner, especially on the manufacturing, transportation, and healthcare. And I think that is also another growth engine for Advantech, in addition to the growth of semicon demand on the equipment and the fab. And the other one is the AGI across a sector of different verticals.
Tariffs, this is a big uncertainty for a lot of businesses. How is Advantech facing the questions? I mean, yes, maybe products are on the exemptions list right now, but what's your thinking about if they don't stay on the exemptions list?
Yeah, at this moment, the product we have, most of them are on the exception list. But we also made some of the plan is that to increase our production capacity in USA. At this moment, we already have the production integration center in Milpitas, California, and we are going to have the second one also in California, Tustin. So that will be double size, which means like we will grow 1% more to double size our production facility in USA. Of course, with the production facility, we will definitely support and help our customer to minimize the tariff. Even though right now, most of our products are in the category of the exception list, but we are prepared to increase our integration in USA.
What are the challenges that you face with scaling up production in the US?
Okay, good question is about labor, the skill set of labor. So What we do, of course, we still need to recruit the skillful engineer and the worker in production. Secondly, related to AI, how can AI help us to be more efficiency than the small logistic warehouse? And also on the production line, how can we embed the AI with the visual inspection, which means that we can optimize the AI technology so that we can, I would not say minimize, optimize resources we have there. So I think AI will be very important enabler for the smart manufacturing for any company if they want to expand their production facility in USA.
Yeah, there we go. That was Advantech, President of Intelligent Systems Sector, Linda Tsai, with, of course, Bell there in Taipei. Okay, just before we go, take a short break here. Chips, speaking of that, right? We were just having a conversation there, and that's still, pick your headline from about 36, 48 hours back, whether that's the Oracle story, whether that's the monthly exports coming out of Taiwan, whether that's the monthly sales numbers. Caught a TSMC on your screens as well, 2.5%. Yeah, so the chip trade, the AI trade, generally speaking, is still doing well. SK Hynix is at the highest level in 25 years. This is Bloomberg.
$11:29 a.m. in Tokyo. Japanese markets heading to that lunch break in just a moment. And yeah, we continue to see quite a bit of tailwinds into this equity market. I think the fact that this whole AI theme continues for another day. You have Advantech that really, even market cap has surpassed the likes of Tokyo Electron. That certainly just goes to show the demand for AI is still very much there with those CSMC numbers that came out yesterday as well. So 1% gains for Nikkei 225. Topics is just up by 5 points there. But yeah, not much movement in the yen here at 147.45, Dave.
Yeah, I'm just looking at the bond space just very, very quickly because we had a bond year auction yesterday, and I think on the 2-year itself, so we've been talking about the long end of the JGB curve as hitting these multi-year highs. The 2-year is actually quite close as well to hitting some levels that we haven't seen almost in several years. So I guess we'll talk about that once, if and when that happens, I guess, is the more relevant question there. Let's stay in Japan. Let's talk about corporate Japan, though. And, of course, one company that's really been in the news has been Nissan. And really when it comes to things like cars and tariffs and all these things, right? So Nissan, in fact, welcomed in the U.S. Japan reaching this deal to reduce these tariffs on vehicles and parts imports to the U.S. Challenges remain, though, in managing those levies alongside, again, this costly business turnaround that's taking place. And the CEO, Ivan Espinosa, spoke with us exclusively about all of that, the impact of tariffs and the progress of these restructuring efforts.
We welcome the improvement from the 25% to the 15%, but as you rightly said, it's still higher than what we were operating with. And what we're doing is continuing our efforts. On one end, we are focusing our marketing efforts on tariff-free products. So we have 2 big manufacturing sites in the United States, where we produce many Nissan products: Pathfinder, QX60, Infiniti. We produce Murano. We produce our Frontier pickup, Nissan Altima. So we have enough product to sell to our customers tariff-free, and this is where we're focusing our marketing efforts. On the other end, we are also continuing our efforts of resourcing some components to improve the tariff impact that we're receiving from some suppliers and tier-end supplier impact, and we will continue the efforts moving forward.
Does that mean that you won't necessarily need to raise prices, and does that improve the demand outlook for the U.S.?
Well, we're keeping a close eye on what's happening in the pricing, and we will take any opportunity that we see coming. Nissan we are having a very quick follower strategy on pricing, so monitoring what our larger competitors are doing, and we will take opportunities as we see fit.
The Chinese market, very competitive. How are you faring, and what's the strategy there?
Well, we see, I would say, a prudent improvement, or what I will call we have prudent confidence. This is how we're qualifying it, because we have 3 months of year-over-year sales growth. We just launched our N7, which is a new energy vehicle that was designed, engineered, and is produced in China. And this car is helping us drive the performance up. So We have, as I said, 3 months year-over-year growth, and that's why we are prudently confident, because the performance is good. The market is very difficult, as you said, so we cannot, say we are already out of the woods. We still need to continue working, but we have more cars coming in the pipeline, cars that were produced, designed and engineered with the Chinese customer in mind, and we're confident that they will keep us driving the success forward.
How are you doing on your funding plans? We understand that you are trying for 1 trillion yen when it comes to debt and asset sales. How much progress have you made?
Well, we raised recently around 850 billion yen already. So what I would say is that we are very well in track on the funding. This gives us a lot more breathing room to keep working on the Re-Nissan plan, keep improving our performance, and we have a lot more runway than what we had several months ago. Yeah, and the good thing is it's showing the confidence of investors in the plan. The fact that they were ready to place this amount of money on Nissan is proof that the plan is solid. It's a plan that is robust, and that management, we were able of convincing the market with our strategy. Yeah.
On the details of how those funds are being raised, we heard about a syndicated loan coming from backed by the UK. Is that included?
It's not included in the 850 that we have raised already. Yeah.
But conversations with the UK are happening.
We're looking at many options all the time, and we'll let you know if there's anything to add later on. Yeah.
What could be the timeline for that?
At the moment, we are not in a rush to raise any more funds. We have, as I said, we have raised 850 billion yen, which is a very big part of what we had intended to do, and we are confident with this amount for the moment. Yeah.
What about asset sales, especially these offices here in Yokohama?
Well, nothing to add on that. We initially looked at many options, but we haven't decided anything. We are in Yokohama. We will be in Yokohama always.
When it comes to the production here domestically in Japan, you are ending them in your flagship Oppama plant by 2028, right? Are we going to see any more closures or reductions here domestically?
Well, in Japan, as we announced, as I mentioned in the last announcement, we have finished with the vehicle production consolidation in Japan. Nothing else will be done on the vehicle consolidation side in Japan. We're still working on some other sites overseas. We announced also Cuernavaca, which was also a very difficult decision to do. But we are on track. We are almost done with the restructuring plan, and we are now in the stage of moving forward to the future, talking about product and launching all new cars here in Japan and overseas.
What happens to those plants, like the Oppama plant?
Well, we will see what we do to repurpose them in the future. Nothing to announce at the moment.
Repurposing, but not necessarily selling it.
We're open to many options. Yeah.
How's your partnership with Renault? The new CEO especially, he was saying he wants to see more partnerships globally.
Of course, I think, this time is one of the most exciting times for the alliance. From the outside, it looks like we are distancing from each other, but the reality is this is a time at which we are collaborating the most. We have so many cars coming. We started with the Renault 5 based Micra that we just launched, which was designed by Nissan, but is now produced by Renault. And this is just the beginning of several projects that we have been working on. And I've known Francois Provost for many years. We've been working together for quite a while. And we have both the same interest, which is keep building, win-win relationship between both companies and keep fostering the alliance for the future.
That was Nissan Motor CEO Ivan Espinosa speaking exclusively with Sherry there. Coming up, we're talking more about China-Britain relations and the like. The Business Council there joining us next to give their take on trade talks between Beijing and London. Peter Burnett joins us next. This is Bloomberg.
Right, welcome back. So we're moving into this U.S. inflation print, which comes out later tonight, of course, if you're watching out of the Asia Pacific. And the estimates are coming up on your screens, and sort of the relevance of this is, I think certainly all roads will always lead to the Fed, but in this case specifically, of course, will lead to not just the September meeting of the Fed and what they're able to do beyond possibly what's now being priced fully. A rate cut and perhaps beyond is the question.
Yeah, not sure if this inflation print is going to really kind of change anything. It seems like it's almost 100% guaranteed that we're going to see a rate cut next week from the Fed. But does it mean, if it's hot, does it mean they can only cut once this year? That certainly is the possibility as well. But yeah, it's going to be an interesting meeting, right? We have Lisa Cook who is going to be actually be in this meeting as well. So there's going to be a lot of, given just the twists and turns with that sort of legal saga that's going on as well. But certainly there's going to be a lot of questions on just how hot it was. The PPI print was benign, as some say, but we'll see if CPI plays ball.
Yeah, and I think the Anna Wong out of Bloomberg Economics and her team actually think it likely will be hot.
Yeah.
And unfortunately, I'm framing it this way, it's not because of tariffs, which perhaps will be the addition in the future, right? So right now it's still the services part of that. And I think the argument really for that is the Fed will really need to take it almost one meeting at a time. In fact, I was speaking earlier on with the UBS CEO who joined us early on. Among many things that we talked about regulation, we talked about Asia and Chinese economies. And one of the things, the sticking point for him, still, I asked him about the outlook for the global economy, and he still thinks we haven't actually seen the impact of tariffs. And that's still an almost complete unknown for him, despite the fact that things are actually doing well in the Asia Pacific. In fact, let's play out part of that conversation we had. Sergio Ermotti joined us here. We talked about Asian economies. We talked about the Chinese outlook. Fairly robust, he says, despite this trade upheaval because of the tariffs. Yeah, he spoke with us exclusively, wide-ranging interview, including, of course, tech, AI, and everything in between. Have a look.
It's fair to say that also this time probably there is an exaggeration of the estimation, but is going faster than what we saw in the past. But I'm pretty convinced that we are still underestimating the impact it will have over the long term. I think that for us is all about really preparing for the future. The biggest focus we have right now is how to make our processes more efficient on the back end, but also how can we help our client advisors serving their clients in a more effective and efficient way, our analysts to be more responsive to market changes. And, you know, one point is very important. Technology will help humans being better. And in banking, we will continue to see the emotional part, the EQ part of the equation playing also a very important role.
You know, the bank has been around through many cycles. I want to get your sense of this current macro environment. I mean, we went into this year with some expectations around how the macro environment would change, and then we had this flurry of tariffs and this back and forth, and now questions around how much the Fed can, in fact, lower interest rates. What's your sense of the global economy, and where do you think we will be in 6 months' time? Are we going to be better off or worse off?
Well, look, you know, the issue is that I don't think we have seen really the true impact of tariffs playing out in the economies. Of course, when you look at Asia and China in particular, it's fairly robust. You know, 5%, you know, comfortably about 5% GDP is quite a strong momentum. And, of course, also China may be impacted by high tariffs. But on the current assumptions, around 40%, considering also that the weighting of tariffs for exporter has changed. You know, in 2017 was probably around 20% of the exports were going to the U.S. Now we are closer to 14%. Of course, when you look at machinery, autos, and technology, there is between 40 and 80%. But you know, what's going on, for example, in this region, diversification, it's a very important topic. So you see Asian becoming much more, you know, developing more into a diversified play. Same is going on for you know, in Europe. The true issue on tariffs will be seen on consumers. In the U.S., we will need to see exactly if there is an inflationary aspect of tariffs.
When you speak to your big corporate clients, do you get a sense that people are more conservative still in terms of their assumptions, their CapEx spending, and just their broad expectations of how things will play out?
Well, I think that there is still a level of uncertainty, although if you look at the world seems to be divided into two, the more traditional, let's call it, economy, and the one that is AI, technology-driven. There is a clear boom and prospect for growth. We see it here in Hong Kong with the booming IPO market. You know, this is something that we saw in the best times.
Right.
But in general, there is a constructive momentum, but the jury's out because the complexity is not only the economics, it's also the very complex geopolitical environment. Is keeping all of us very focused on making sure that we are not becoming complacent.
Right, and there's this renewed, let's put it, a healthy competition coming from some of your Chinese peers in the industry. Do you get a sense that the competition now is a bit more fierce, and how are you prepared to respond to all? How is UBS prepared to respond to this new regime?
Well, I don't remember in my career times in which competition wasn't fierce, look, I think that it's good to see that also Chinese securities firms and banks are broadening up their capabilities. We see us as a complementary player in that sense. So we are helping international investors that wants to invest in China and in Asia, and also the other way around. And this is very complementary with the rest of the industry and the competitive landscape.
And that was UBS CEO Sergio Ermotti. They're speaking with David exclusively a little bit earlier on today. To some other stories that we're tracking for you today, the FBI has released a person of interest from custody after conservative U.S. political activist Charlie Kirk was killed during an event at Utah Valley University. The 31-year-old was speaking outdoors when he was fatally shot. Kirk was a close ally of President Trump, who posted about the incident on social media and ordered American flags to be lowered to half-staff until Sunday. Bloomberg has learned that Poland has requested additional air defense systems from its allies to better protect itself against Russian incursions. It follows the downing of drones that crossed into Polish territory during Russia's latest airstrike on Ukraine. Sources say Warsaw is consulting with NATO partners for further assistance after invoking Article 4 of the alliance treaty. Hong Kong's legislature has rejected a landmark bill that would have formally recognized same-sex partnerships. The move is a blow for the LGBTQ community and risks undermining the city's image as an inclusive hub for international business and talent. In 2023, a top court ordered the government to establish laws recognizing same-sex partnerships. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. So we have UK's new business secretary, Peter Kyle, is in Beijing to hold the country's first trade talks with China since 2018. It comes as Prime Minister Keir Starmer is looking to boost growth in the UK, and that's ahead of Donald Trump's visit to the country next week.
Let's bring in Peter Burnett, Chief Executive of China-Britain Business Council, who has been accompanying Kyle throughout his visit as part of his business delegation. Peter, it's great to have you on the program. Obviously, we talked about it's a 7-year hiatus since we've seen trade talks of this level. Can you tell us more how significant this trip is, really, and what are some of the plausible outcomes?
I think it's very significant. It's pretty extraordinary that the country has not been engaged in trade and commerce discussions with China for that period of time, frankly. And it's the second largest economy. It's a very major trading partner for the United Kingdom. And so it's highly significant that this should happen, and I think that's reflected in the pretty warm welcome that the new business secretary has received from the leadership here. He met with Ho Li Feng yesterday, Vice Premier. I was very privileged to be part of that meeting, part of the delegation, and it was a warm welcome and an encouragement to deepen ties and to do more trade, to see where there are areas where we can iron out frictions and improve market access both ways.
Peter, David here, if you could maybe elaborate more on, now that sort of the warm welcome's been behind us, hopefully, and we can now talk about the tangibles. Are there any tangible expectations that you have in terms of opportunities both ways, of course?
So the discussion which takes place in something called the Joint Economic Trade Commission, is scheduled to take place today, in fact. So you've got me slightly earlier than we've got the outcomes. But there was a release made by the UK government just yesterday morning, which sort of front runs some of the outcomes, if you like, and it refers to £1 billion worth of additional trading opportunities. and it highlights some of the areas where that will happen. £2 billion worth, I'm going to talk in pounds, I'm afraid, £2 billion worth of economic growth over the next 5 years.
The business secretary, I believe he is arriving in China after a trip in D.C. I'm just wondering, there's been a lot of talk of the Trump administration urging Europe to at least slap, 100% tariffs on China. Has the UK faced some sort of pressure in any way to do the same? Or, how does the UK really deal with these two bilateral relationships?
It's very complex. It's a difficult road to navigate. And the way that the UK government is behaving, I think, and managing that process has, I think, been pretty successful so far. I think when the new government came into power, there were 3 priorities on the international stage. The first one was to re-establish and renew a sensible relationship with the EU. The second one was to continue but renew its engagement with a changed United States. And the third one was China. And navigating that route has been pretty difficult. But I'm going to quote you from Lord Palmerston, who was a very famous foreign secretary of the 19th century. And he said, "We have neither permanent friends nor permanent enemies. We have only permanent interests." And I think that's the modus operandi that the British government is following, which is to ensure that the decisions it makes, the deals that it concludes, the agreements that it comes to are really in the best interests of the United Kingdom economy. So that includes having a positive engagement in the US and having a very positive engagement here in China. So far, that seems to be working, but it is difficult and it is challenging. I don't think so far there have been threats or pressures to do things differently, but it's a hard road to hoe.
Peter, are there any plans for the Prime Minister to eventually make a trip, Keir Starmer? Do we see him in Beijing at some point?
I hope so. I think the business community would very much like that. He's met with Xi Jinping on a bilateral basis in the G20. He's had a telephone conversation with him. I think he comes, Peter Kyle, the new business secretary, was here with messages from Keir Starmer. I was in Xiamen on Monday and Tuesday at the China International Fair for Investment and Trade, the big CIFIT conference, and there was a letter from Keir Starmer read out to that conference, which counterbalanced the letter from Xi Jinping, also read out at the opening of that conference. So, look, I think the engagement is there, and we all very much hope that he will be here probably in the first quarter of next year. We would encourage that. We think it will seal a really important development in the relationship.
Peter, hope you have a fruitful trip over there. Thank you. Peter Burnett, Chief Executive of the China-Britain Business Council, joining us from our Beijing studios. We're taking a little bit of a check here when it comes to markets. And yeah, we continue to watch what the Alibaba story and how that is all evolving here today after announcing that convertible bond. There you go. That stock is still down about 1%. I think we're off some of the lows, but really it just goes to show, it really has dragged down parts of Hong Kong. Meituan certainly is definitely something that we continue to see where those losses keep deepening, Dave.
因为团队, right? Competition. Let me borrow that second word. Different one, of course, out of Meituan. I think that's really dragged on that. And of course, speaking of Meituan, also mulling and considering its first ever tapping. Of course, this is the bond market specifically here to raise funds. And let's build a cash pile to dig in for competition, I guess. We're looking at port stocks before we go and before we head off to lunch, in fact. And we're looking at some massive gains here, of course. In some cases, this is on the back of this report that perhaps were discussions there around, would it be reduced output? Anyway, we're looking at the markets reacting already to that. But apart from that, the AI trend continues across the Asia-Pacific. Markets are doing actually better than it was initially thought early in the morning. CSI 300, 0.8%. That's it from us here on The China Show. We'll see you all tomorrow.